What if I was to tell you that Wall Street is aggressively pushing investments into your 401ks and IRAs that charge 50 times more in fees than index funds, give you zero transparency into what you actually own, and have questionable track records despite all the marketing hype? Well, that's exactly what's happening right now with private investments. Major firms like Blackstone, KKR, State Street, and others are targeting everyday investors with private equity, private credit, and private real estate funds. They're calling it democratization, giving you access to investments previously reserved only for the ultra-wealthy. But when you dig into the actual data, are these truly beneficial to individual investors like you and I? I personally don't think so. To me, it all looks like a fancy magic show by Wall Street, and the most unfortunate thing is that people like you and I are paying for that expensive performance. Alright, so let's get into some of the major problems I find with private investments. Let's start with the most obvious problem: high fees. And when I show you these numbers, you'll understand why Wall Street is so eager to get you into these investments. When you invest in something like the Vanguard's Total Stock Market Index Fund, you pay 0.04% annually. That means on a $100,000 investment, you're paying just $40 per year in fees. Even a more expensive actively managed fund might charge 0.5% to 1%, which would be $500 to $1,000 annually on that same $100,000. Now let's take a look at private equity. The standard fee structure is called 2 and 20. That's 2% annually plus 20% of any profits they generate. So in that same $100,000 investment, you're immediately paying $2,000 per year just in management fees before they even make a penny. And if they do make money, they take 20% of those profits off the top. Let's take a look at how the math actually works out. Let's say your private equity fund of $100,000 grows to $115,000, a $15,000 gain. How would the fees work out? Management fee: 2% of your original $100,000 equals $2,000. Performance fee: 20% of that $15,000 profit equals $3,000. Total fees equals $5,000. So out of your $15,000 gain, you keep $10,000 and the private equity manager keeps $5,000. That's right, they took 1/3 of your profits. Plus, they got paid $2,000 whether they made you money or not. Now, let's compare that to if you had just invested that $100,000 in a simple index fund that charged 0.04% expense ratio and also returned 15%. Your money grows to $115,000. Same $15,000 gain. However, your total fees, 0.04% of $115,000, $46. That's right. The total fee here is $46 compared to a total fee of $5,000 in our private equity fund. How is that for a difference in fees? Puts things in perspective, right? But I know what the private equity fans who see these numbers are saying. Hey, that's not fair. Just showing the expenses isn't apples to apples because these private funds charge a higher fee for a reason. They're investing in much more sophisticated investment strategies to provide better returns to its investors. Well, good point. That is, if they're truly providing a better return. Let's get into that next. The second major problem with private funds: the superior returns problem. Private investments argue that you should tolerate the high fees that we just discussed because they provide superior returns compared to a simple index fund that tracks the market. But how true is this? Let's take a look at the data. When you scour the internet for data, you can actually find plenty of studies that seem to show private equity outperforming the public market. For example, Cambridge Associates, an investment firm that advises endowments and pension plans, publishes data showing their private equity index outperforming public stock indexes by around 5% per year over various time periods. Sounds impressive, right? But here's the problem. Those returns are calculated using something called internal rate of returns, or IRRs, which account for the timing of money flowing in and out of the investments. They're not the same as the straightforward returns you see from mutual funds or ETFs. Cambridge has to adjust the public market's returns to account for these cash flows, creating modified public market equivalents. It's comparing apples to oranges, and thus you should take these comparisons with a huge grain of salt. More importantly, you actually can't invest in Cambridge Associates' private equity index. It's not like buying an S&P 500 index fund. You have to somehow gain access to all these private funds that make up that index, which is almost impossible for regular investors. But here's a real test. If private equity truly outperformed public markets consistently, you'd expect institutions that are loaded up on private investments to outperform simple index-based strategies. And college endowments are a good test case because many allocate even up to half of their portfolios to private assets like private equity, private credit, and private real estate. So how have they done? The data is clear. They haven't beaten simple index fund strategies. Looking at 10-year annualized return from 2015 to 2024, the average college endowment returned about 7% per year. Compare that to simple portfolio strategies that any investor can implement. A 3-fund portfolio with 60% total stock market index, 30% total international stock index, and 10% total bond market index would have returned about 8.5% annually. A simple 2-fund portfolio with 70% total stock market and 30% total bond market would have returned about 8% annually. These endowments have professional investment staff, access to the best private managers, and can make investments that regular people cannot access. And they've allocated up to half their portfolios to these supposedly superior private investments. And they're getting beaten by simple index fund strategies that you can implement with a few clicks on your phone. But wait, it gets worse. There's a huge variance in private investment returns, meaning that the gap between the best and the worst performers is enormous. While some top-tier private equity managers have delivered excellent returns, you could drive an entire convoy of trucks between the top and the bottom performers. If you end up in the bottom quartile private equity fund, and 1 out of every 4 investors does, you're going to have a terrible experience. You might never want to hear the word private equity again. And even if you land in the middle of the pack fund, they probably won't meet your expectations after paying all those massive fees and dealing with illiquidity and complexity. Before we dive into the next issue with private investments, there's something really special I want to share with you. For those of you who want a more hands-on support as you work through your finances, I want to let you know about an exclusive program, introducing the Financial Tortoise community, and it is now open for waitlist signups. This community is your ultimate roadmap for mastering your money, systematizing your finances, and securing your family's financial future. Close to 15 years ago, my wife and I were completely broke. We not only unwisely spent all of our savings on an expensive wedding, but we were buried under $105,000 of student debt. Financial anxiety was a daily reality. We constantly worried about money because we couldn't see a path forward. Well, thankfully, by learning from some great financial mentors, we were not only able to learn how the truly wealthy manage their money, we were able to work our way through our 6-figure student debt and eventually achieve financial peace. And I want to share everything I've learned with you through this special offer. Inside the community, you'll find a structured path to building lasting wealth designed specifically for professionals who want steady, sustainable growth without the hype or unnecessary complexity. Exactly the stuff I talk about in this channel. The Financial Tortoise community includes personal one-on-one coaching sessions with me, where we'll address your specific financial questions and create a personalized plan aligned with your goals. Step-by-step, member-exclusive courses on everything from developing the right money mindset to designing your ideal investment portfolio to minimizing taxes. Monthly live Q&A calls where we dive deep into key topics and keep you accountable. A private forum connecting you with other hardworking professionals on the same wealth-building journey as you. Practical tools, templates, and resources that simplify your financial decision-making. And I'm especially excited to offer members a complimentary subscription to Monarch Money, a powerful financial tracking tool that helps you organize your accounts, track your spending, and visualize your progress all in one place. This alone represents a significant value, but it's just one of the many resources you'll gain access to. However, to maintain the quality of the support each member receives, I only open enrollment a few times a year. So join the waitlist today at financialtortoise.com/community to be first in line when doors open next. Plus, as a special bonus for joining the waitlist today, you'll receive a free special gift delivered straight to your inbox, automatically just for signing up. Remember, real sustainable wealth is not built overnight. It's created through a slow, consistent effort that compounds over time. Exactly what we focus on inside the community. Many members have completely transformed their financial lives, and with the right guidance and clear plan, you can too. You deserve it. I would love to see you inside. Alright, with that, let's get back to the video. The third major issue with private investments is the complete lack of transparency. And this is not just an inconvenience. It's a fundamental problem that affects everything from risk assessment to performance measurement. When you invest in public markets through something like a total stock market index fund, you get incredible transparency. The fund is priced every single day based on the actual market value of thousands of publicly traded companies. You can see exactly what stocks the fund owns, what percentage of the portfolio each represents, and what the current market thinks those companies are worth. The SEC requires detailed filings, and everything is out in the open. Private investments are the complete opposite. The valuations are set by the same managers who are charging you fees, and that creates an enormous conflict of interest. A quite sleight of hand if you ask me. Think about it. If a private equity firm charges 2% of assets under management, they have a direct financial incentive to value those assets as high as possible. Yes, there are third parties and guardrails to help mitigate this, but the conflict still exists and transparency is virtually non-existent. Let me give you a perfect example of how problematic this can be. When Elon Musk took Twitter private in late 2022, various Fidelity and Barron mutual funds had co-invested alongside him. Thus, these funds had to figure out how to value their shares of this now private company. For most of 2023, Fidelity marked its holdings down by about 60%, while Barron only thought the value had dropped by 20 to 30%. These are professional investment firms looking at the exact same company, and their valuations were off by 30 to 40%. Eventually, Barron lowered this estimate to roughly match Fidelity's, but imagine being an investor during this time with no idea what your investment was actually worth. The lack of transparency also creates an illusion of low volatility. Private equity investments often show lower volatility than public stock investments, and managers love to tout this as a benefit. But here's the thing, they're not actually less risky. They just look less volatile because they're not priced every single day. Think about your house. The value of your home fluctuates constantly based on market conditions, comparable sales, interest rates, and dozens of other factors. But you don't see that volatility because you're not checking Zillow every day and because there's not a liquid market pricing your house minute by minute. Your house doesn't become less risky just because you don't have real-time pricing. The same principle applies to private investments. This creates a dangerous, false sense of security. Investors think they're getting the benefit of stock market returns with bond-like stability, but they're actually taking on all the underlying business risk without the benefit of transparent, market-based pricing. When things go wrong, and they do go wrong, you might not find out until it's far too late to do anything about it. Alright, so if private investments have these massive problems with fees, questionable returns, and transparency, why is Wall Street pushing them so aggressively right now? Well, let's get into that next. Let's break down the concept of democratization, giving everyday investors access to investments that were previously only available to institutions and the ultra-wealthy. It sounds very altruistic, right? But a complete myth and a big problem at that. Here is a simple, one-sentence reality of why they're perpetuating this myth. They've run out of other people's money. The private investment industry has essentially tapped out their traditional customer base. Institutions like college endowments, pension funds, and sovereign wealth funds already allocate up to 35% of their portfolio to private assets. That is a lot, and it suggests that these institutional investors are probably maxed out on private investments. So when you saturated your existing market, what do? You find new customers. And that is exactly what is happening right now. Wall Street has turned its attention to everyday investors, what they call mom and pop. And they're specifically targeting retirement accounts like 401ks and IRAs. For decades, pension funds, university endowments, and the ultra-wealthy have fueled PE's explosive growth. But many of those institutional investors are now tapped out. The only option is to reach out to a new channel. That channel? Over 120 million Americans with defined contribution plans like 401ks and IRAs, totaling more than $40 trillion in assets. And why specifically retirement accounts? Because the money is sticky. Once your money is in a 401k or IRA, you're much less likely to move it around frequently. And when that money gets invested in illiquid private investments, it becomes even stickier. You literally can't get it out even if you wanted to. Thus, look what's happening across the industry. Capital Group, the company behind American Funds, has launched interval funds with KKR that includes private investments. State Street created an ETF that stuffs private credit alongside Apollo Group management. The 401k giant Empower is partnering with several different firms to allow private assets into retirement accounts. These companies have built their reputation on serving everyday investors with relatively straightforward products. Now they're rushing to offer the most complex, expensive, and illiquid investments available. Why the sudden change in philosophy? The marketing pitch is always framed as democratization, but this is not about helping you. It's all about revenue generation. These firms need to find new sources of assets to charge their high fees on, and retirement accounts represent trillions of dollars in potential fees revenue. To put this shift in perspective, traditional private equity funds typically require minimum investments of $1 to $5 million and are limited to accredited investors, people with over $1 million in net worth or $200,000 plus annual income. These are not investments for regular everyday people. They're for the wealthy. But now these same firms want to package similar products for your 401k. Sounds pretty fishy to me. Next, let's talk about what I like to call the structure trap problem. Because this one many people do not understand well, but very important if you're looking to invest in private investments. The fundamental problem is this. You're taking illiquid investments, things that can't be easily bought and sold, and shoving them into structures that promise daily liquidity. It's like trying to put a square peg into a round hole. Let me give you a specific example. State Street created an ETF called the SPDR SSGAIG Public and Private Equity ETF with the ticker symbol PRIV. This fund stuffs private credit investments into an ETF structure that trades on the stock exchange every single day. But here's the problem. While you can trade your shares of the ETF daily, the underlying private credit investment can't be sold quickly if there's a rush for the exit. What happens when there's a market stress and lots of investors want their money back at the same time? The fund might have to sell its most liquid holdings first, leaving it holding a higher concentration of illiquid private investments. Or worse, it might have to freeze withdrawals entirely, leaving you stuck despite owning what you thought was a liquid ETF. This mismatch between the liquidity you were promised and the liquidity of underlying investments is a recipe for disaster. And by the way, that PRIV ETF is currently yielding around 4%, barely higher than what you can get from a treasury bond. So you're taking on all this additional risk and complexity for virtually no additional return. The bottom line is this. The structure of these products matter, and most of them are poorly designed for the underlying investments they hold. You're being sold products that promise things they can't deliver. And when the market stress hits, you'll be the one holding the bag. Alright, we covered a lot so far, and the chances are all these talks about private investments might be making your head spin at this time. It sure did for me when I first started researching it and trying to understand it. So if you're still on the fence about private investments, let me conclude with a quote from David Swensen. And for those of you who may not know who David Swensen is, he's a legendary chief investment officer for Yale Endowment who pioneered the use of private investments in institutional portfolios. He literally is the guy who made private equity work for Yale. And guess what he said about regular investors trying to do the same thing? In the absence of truly superior fund selection skills or extraordinary luck, investors should stay far, far away from private equity investments. Think about that. The person who successfully used this strategy at Yale is telling you to not try it yourself. The truth is that complexity is not a winning investment strategy. The financial industry loves complexity, but not for the reason that benefits you. They love complexity because for every additional layer, alternative investments, complex structures, and sophisticated strategies create opportunities to charge higher fees and seemingly make their services seem more valuable. But complexity often works against your interest as an investor. Simple index fund investing isn't boring because it's inferior. It's boring because it works. The magic is not in finding the next complex strategy that promised to beat the market. The real magic is harnessing the long-term growth of human innovation and business development through broad market ownership. So don't let Wall Street's sophisticated magic show distract you from this fundamental truth. Simple, consistent, low-cost investing has created more wealth for more people than any complex alternative strategy ever has. Thank you guys for watching the theme of simplicity investing. Check out my video here on best lazy investment portfolio strategies. Until next time, all the best.